the friends in the room. And hopefully that makes this discussion easier if we're a smaller crowd. So please, we hope that you join in on the Q&A section. As you know, you're here for this New Frontiers in Client Protection panel. And we have an interesting setup today where we're actually going to cover 3 subtopics. So you'll see a little bit shuffling of speakers. We'll start with our DFS group, and then they will leave the stage and we'll welcome our PAYGo Solar group, and then they will leave, and then we'll have a discussion on agribusiness, and then we'll conclude. So we'll pack a lot of content about consumer protection, and in particular what makes it unique in each sector into this panel. So let me show you our agenda. I will introduce the speakers in a second. We're going to do a quick overview of the state of practice, and then we will jump into the DFS world. And after about 45 minutes, we will switch to our PAYGo Solar. And then, as I said, end with agribusiness. And in each case, we are reserving some of the time for the panel discussion and some of the time for Q&A. So we do, again, hope that you think of some questions or comments and certainly participate when it comes to that. Okay, so let's meet our speakers. I will have them introduce themselves briefly. So let's start at the end. Lucia, please.
Good afternoon, everyone. This is Lucia, Innovation Director at rating agency MFR. Pleasure to be with you until the end.
Good afternoon, everyone. My name is Jack Ngoma, CEO for Microloan Foundation. We are a microfinance institution in Zambia, which is focused 100% on providing financial services to women. We currently stand as the second largest social impact microfinance from a client number perspective. Looking forward to the discussions. Thank you.
Hi, everybody. Eric Duflos. I lead our work on consumer protection and responsible digital finance at CGAP.
And I'm Amelia Greenberg, Deputy Director of SPTF. And one note about our presentation, it's going to be available online. And so each of us put a slide in about our organizations, including some links to key resources. So I'm not going to spend time on them today, but you'll have access to this document. And if you want to know our websites or our emails, and we certainly hope you do, or download our resources, please remember to download this presentation. And so we'll just go through these slides and get right to the discussion. So before we launch the DFS portion of today's chat, Eric and I are just going to do a brief overview of some key concepts for you. One is the risk that we're currently observing generally related to consumer protection, which makes this issue both urgent and very important. And then Eric will briefly give you a summary of the digital ecosystem concept and why that's an important concept to think about when we're focusing on solutions. And then I will briefly talk about the digital financial services standards. And so that'll be just short. All of it is not going to be in depth, but we want to make sure you're aware of the key concepts, and then we'll jump into the more detailed discussion. So Eric, with that, let me turn it over to you.
Thank you very much, Amelia. So why do we need a new approach is actually because there are so many risks in digital finance for consumer protection. We all know that digital finance is transformational in many respects, in terms of increasing access and usage of financial services for low-income consumers. But CGAP conducted a research that probably many of you have seen that was published a year ago that showed that not only the nature of the risks was becoming increasingly complex with 60, I think we counted 66 types of risks in digital finance that we then categorized into 4 categories, which is the lack of transparency, frauds, the lack also of recourse mechanisms, and data misuse. And then we have 2 other categories of risks that are transversal, I don't know if you can say that in English, which are agent risks and network downtimes. So nature of risk has become more complex, in particular in terms, of frauds with social engineering. I'm sure you're receiving a lot of, emails and text messages. So you can imagine for less digitally literate clients what it means. And what we have seen in terms of scale is that for the first time ever, we've been able to sort of accumulate, and review all the evidence and the data that exists globally to try to see what was the scale. And what we saw is that there was a rapid evolution globally and at the country level for all the data we could find on frauds and on misuse of data. On the other risks, they were also increasing, but we had less solid evidence. But we have solid evidence showing that frauds and misuse of data are really increasing for everybody, including low-income consumers. Obviously, women are also more at risk, although the data is not always that clear on this particular issue, but all the research we've done shows that in terms of digital literacy, women are behind men on this front for different reasons. And that affects, of course, their vulnerability to risks. So in face of this, situation, and also in face of the fact that in spite of the progress that has been made by, SPTF, working with hundreds of providers, AFI, and many countries have put in place frameworks for consumer protection. Many countries have also created some form of institutional framework in addition to the regulatory framework, but still the regulators and the supervisors are behind. So we're seeing that there is a need for a more ambitious approach. And that's what we call the responsible digital finance ecosystem approach. Why is it more ambitious? It's because we want to increase collaboration among different actors in the digital finance ecosystem, whether we're talking about all the organizations that you represent at the, and who are active at the country level, whether we're talking about SPTF in working in specific countries, whether we're talking about CGAP, whether we're talking about you who lead a provider, a financial service provider. All these actors need to collaborate more. And this is not, we don't want this to be a fluffy word. We want to find examples of very specific types of collaboration that we want to see in place. Collaborations among different types of regulators, data protection. You want me to
speak up? Oh, a little.
Oh.
But you also have 30 seconds. So.
Okay. So yeah, thank you very much. So what do we mean by more ambitious? More collaboration. I think I've been clear on this. We also want more customer centricity. So that means much more focus on the needs of the consumers, from regulators, from providers, from funders also, investors. And then we want also to build up more capabilities. So what we're doing at the moment is we're trying to develop a methodology with tools and guidance to do this, and we're going to pilot this approach in 2 countries in the next 4 years, and see if we can get better results in terms of consumer protection.
Okay, and we will, I'm sorry to cut it short now, but we will have a chance to revisit this concept in practice. But for now, we'll turn it over to Jack. So Jack, as he just told you, works in Zambia for Microloan Foundation, for those of you who just got in, and has some real experience with these risks that we're talking about. So if you could briefly describe what digital products you are offering, and then the main risks that you've been confronting as you implement them.
Well, thank you very much. So as given in the introduction, we are a microfinance institution which is fully focused on providing financial services to women, mostly rural-based women in some of the remote areas and also in some of the poor communities in our country. Our main focus is obviously credit. So we're a non-deposit taking microfinance institution. So the risks that we obviously are going to discuss will be focusing a lot on the aspect of credit that we are providing. As an institution working with a number of partners, we've digitalized all our loan processes, majority of our loan processes. For example, loan disbursement currently is 100% using digital means. We've moved away from cash handling. And I think it is because of these innovations that's the more the reason why we find this discussion ourselves very, very interesting, to be able to discuss some of the major things that we have observed with the recent moves that we have made. I think from our end, we can basically say that one of the biggest risks that we see in the institution is the risk of fraud. This is a big issue for us, especially also if you take into consideration the demographic of clients that we're working with, who are mostly rural, where digital financial literacy is even lower. That actually compounds the problem for us. And the main types of fraud that we see with our clients are issues where, for example, fraudsters having unauthorized access to some of our accounts, clients' accounts, and maybe having access to the loans. We also see a lot of tricky messages being sent where clients are tricked to reveal personal information, maybe passwords or things that are there to protect them. These are some of the issues that we are really kind of facing with the new digital services.
Yeah, and just to follow up on that, when we were talking earlier, we were saying the fraud is also evolving. So another challenge is, even if you've trained customers on awareness of certain types of ways of being tricked, tomorrow there can be a new way. So fraud, clearly, but also Lucia, over to you. Lucia's had worked with a number of different institutions. So in that broader view, what are some of the more common risks that you've been seeing?
So look, fraud has always existed and will keep on existing. I remember I was once rating one institution in Central Africa, and I see a jump in the staff turnover rate. And after some investigation, this coincided with the introduction of POS machines that daily saving and credit collectors would use to go to the field and now register the payments and give a ticket to the clients. And all of a sudden, that job was not interesting anymore for those agents whose main interest was fraud, and so hence the massive. So this is to say that technology helps decreasing some types of traditional fraud risk that we have seen, but it also increases other types of more modern fraud. And I remember when I was driving to the supermarket in Central Africa, I would see an advertisement saying, "With us, your e-wallet doesn't disappear," meaning that with everyone else, yes, but we are the exception. So this being said, so fraud, cybersecurity, over-indebtedness are big concerns, but there are also ways to manage.
And that's a nice segue into the next part of our discussion, which is what management practices have you observed that tend to mitigate the fraud? And before I kick this back to our panelists, I want to say that this has been the primary focus of my work with SPTF for the past 18 months. We have been interviewing experts and now testing possible mitigating solutions in the field, and we've collected those ideas in a document that we're calling the DFS standards. So that is an attempt to put some of the ideas that we heard over our 18 months of research onto paper, into a tool to say, if you would like to mitigate these risks that you're hearing about, here are the management practices for a financial service provider to put in place. But for some specific examples, let's go back to our panelists. And Jack, I'll start with you again. So fraud has been one of the biggest concerns, and what have you found to be useful to mitigate that risk?
So for us, I think naturally, looking at the kind of market we are serving, one of the things that we already thought was critical was element of training. And so we have continued engaging clients on a regular basis on different digital financial risks. But I think that our training do go beyond just providing risks related to fraud. We provide much more training on just how to understand the technology that they're using. And interestingly, I remember a few years back when we were just launching taking our first steps into digitalizing our process, one of the report was very clear that with the market that you're working with, this is not really going to be a success because there's so much digital illiteracy. People don't know how to use the technology. So maybe that was one of the reasons why from the beginning we engaged a lot of our clients in training. In the first years, we did experience quite a number of fraud, but I must say we are also excited to see that these are trends that we're beginning to see are reducing, and particularly this year we have relatively had a very, very good year in terms of amounts of fraud that have been reported. But the second issue that we also have maintained is what we are calling the high-tech and high-touch model. So despite the introduction of digital means in many of our processes, we still maintain a very high-touch model. We have not replaced our field officers. They're still available. They're working with the clients in the field. So if the clients are not understanding some of the issues, there's always someone that they can talk to. And we find that really helps in terms of managing some of the issues that are there. The last one, which I admittedly would say is really very tricky and very difficult, but we also try hard to ensure that we maintain client confidence. And in other situations where clients have recorded losses as a result of fraud, we have intervened and provided refunds, or at least reimbursed the clients on the fraud amount. This has a number of steps. We work closely with some of the police to ensure that the fraud is really investigated in detail, and where it is clear that these are outside factors and the client has no part to blame, the institution has intervened and ensured that the loss is not taken by the client. So I would speak basically on those three as some of the key interventions that we have applied together with our digitalization processes.
And I'll add to that, that is coherent with what is in the DFS standards on fraud, where we ended up having a part of the standards focus on preventative, like being aware of what the risk is and training clients, and then also the reaction. It's going to occur anyway, so what is your responsibility? And the consensus view was, if the client is negligent, like if you said don't share your password and they shared it anyway, it's harder to tell the financial service provider that they need to refund the client. But if the client was fooled and it's really not their fault, it's incumbent upon the financial service provider to find a solution, including reimbursing. And as Jack was saying, even if that's a loss in the moment, if you don't do that, the client loses trust in the whole system, and then you lose your DFS client. So excellent example from the field. And Lucia, in some of the other areas of risk, have you seen particularly interesting mitigating practices?
Right. Well, following on fraud and cybersecurity, very important example, and congrats on that. Also being very serious when it comes to fraudulent agents and immediate termination and blacklisting, which is not always easy, but very important. Cybersecurity does take investment into vulnerability assessments, penetration testing, cybersecurity, internal and IT external audits, at least every 3 years. Having seniors in a cybersecurity committee really helps, so that they sit and they talk about data incidents monthly, and they report to the board audit and risk committee. The other topic is over-indebtedness, which is maybe complementary to this, and to avoid the Friday night beer or bet nano loan. So good practices there include the minimum 3 confirmations of interest before loan approval. There's a lot that can be done, as it has already been displayed in the previous days, with transactional data and tailoring repayment plans to the patterns that are seen in e-wallets. Very interesting also to use the same data to early recognize signs of financial stress of clients and avoid maybe a subsequent loan to clients that are already displaying signs of vulnerability. Financial education was already mentioned. Mystery shopping is also very interesting when it comes to verifying that your agents are not engaging in aggressive sales, for which scripts are important, but ex post is also very necessary.
Okay, and Eric, I'm going to have you compliment, because the research that CGAP has done, they've done some country-specific research on how many customers have experienced some sort of challenge using digital financial services, and then of those, how many have actually lost money. So the challenge could be, I transferred money to the wrong person, or the network was down, or the agent didn't have liquidity. So that's kind of a high range. But if you can speak generally to what the data are showing about, on average in a country, how many customers are experiencing a challenge, and then of those, about how many tend to be losing money.
Yeah.
Can you turn on your mic?
Oh, thank you. Yes, indeed. So as part of our work on consumer protection, we have launched what we call the WEMU Digital Finance Consumer Protection Lab. So we are working in several countries in the WEMU region, and we're doing national surveys. So we did one in Senegal, two in Côte d'Ivoire, one on broad digital finance, and one on digital credit for Côte d'Ivoire, where digital credit is also, quite widespread. And we're doing a third one in Burkina. So the main data to remember is that 80%, over 80% actually, of users of mobile money and digital finance services have been exposed to a risk in the past year in both Senegal and Côte d'Ivoire. And then in Senegal, 32, I think, between 32 and 36% have lost money out of it in the past year, and 40% in Côte d'Ivoire. So, and when it comes to digital credit, more than 70% of users of digital credit in Côte d'Ivoire have not paid back their loan in time. So that's also worrisome.
Thank you. I want to ask this room also, how many of you, if you can just raise your hand, have received some sort of fraudulent communication via your phone or your email anytime, ever? Yeah, look at the hands. I got one yesterday saying I was getting a security invoice or something for $400, and yeah, the next question is, well, you don't have to confess. I didn't pay my security invoice, but I do know people who have lost money. Has anyone lost funds because of fraudulent activity? Some, yes. So and I have had my identity stolen, and we have more sophisticated tools to deal with that. So just imagine how easy it is to fool people. And Jack was telling me the fraud is just getting more and more sophisticated. So it's really, really a problem. The other one that I wanted to mention from our research is transparency. And this is one where I think there's a challenge with regulation, which often tends to say you must honestly and transparently disclose terms and conditions, and people comply with that regulation, and yet clients don't know what the terms and conditions are. So one of our strong risks that we're seeing is that people are taking out loans or just sharing their data in any way without really understanding how it will be used or what the risks are, what the fees are. And one of the mitigating solutions we're testing in our DFS standards is requiring every provider not only to disclose, but also to check whether customers have understood. And that relates to some research on complaints that IPA did that we found very interesting, which is that a significant percentage of people who have a problem don't bother to complain. So if you really want to know how it's going, you need some sort of proactive outreach to your customer base to say, have you had a problem? And we're understanding from the field that there's even quick SMS messages that some institutions are using to check whether people have understood terms and conditions. You can even do little quizzes, but make it more possible to define transparency, not just as disclosure, but also did the customer understand? Okay, so let's get into the next question. We have been working on promoting better practice, and it sometimes goes well and sometimes doesn't. But I wanted, Eric, and we'll start with you, if we think about the main challenges that you face, either with your partners with whom you work or for Jack with your own institution, what are the main challenges as you look at this digital ecosystem to get actors to take action to improve customer protection? And on again.
So yes, I think for me there are several challenges. The first one is that very often consumer protection and responsible finance, we're often being seen as like, the stick. It's not seen as an opportunity enough. I think we need to think that responsible finance is actually a fantastic opportunity. It's a fantastic opportunity to build stronger trust in the financial sector among consumers. It's a fantastic opportunity to increase your business, because if people trust your services, they will buy more of your products more often. So I think we have to think about this a bit more in terms of how we communicate and how we incentivize. Because what I find is that a lot of the regulators are quite interested. When I see the work we're doing, for example, in the WEMU region, it's quite easy to get the attention of different authorities. It's relatively easy to get, the interest from investors, from international organizations, but a lot of the providers, it's harder, frankly. It's harder to get traction, and I think it's because we need to come up also with more data and evidence that is showing that this is an opportunity for them. Another challenge that I'm seeing is resources, because there are a lot of issues in terms of capabilities at many different levels. The regulators and the supervisors are completely falling behind, sometimes don't have a proper department in charge of consumer protection, don't have the tools or the funding to use market monitoring tools to understand what's happening in the market. So we need much more resources. There are funders, international funders, like the World Bank, the AFD, the regional banks, also the Gates Foundation, who are providing support. But we need much more, I think, international support for this cause, because capabilities, again, is a very, very deep issue in a lot of countries. So that's what I would say.
And I have an anecdote from a workshop that Eric was nice enough to invite me to, where one of the problems that was brought up was network downtime. Like, there's a lot of network downtime and clients want to transact, or they started transacting and then the network went out. And one of the mobile network operators said, I wouldn't say network is a problem. And so there's also the challenge of people get defensive, or they don't want to hear that they need to be doing more, in my experience. But let's go down. So Jack, from your perspective, when you think about your own institution or the partners with whom you work, what are the main challenges? Certainly funding, but what comes to mind in terms of putting in place the consumer protection practices you want to?
Well, thank you. I think I must start by first admitting that over the years, I have actually seen an improvement in the way we collaborate among different stakeholders. So this begins from the fintech partners we are working with, a bit of improvement also in the regulatory side. So I would say that now the biggest challenge I find in the institution is to really respond to the fast-changing nature of the fraud that we have to face on a regular basis. And this is more because if you think about the way I explained at the beginning, that one of the approaches we have taken is to continuously provide training as a mechanism of our clients' understanding. But you design your training particularly maybe based on what you have observed as common areas of fraud. That changes fast. And as an institution, together with your partners, you're not moving at the same rate. So the time that you're actually responding to that threat, a lot of issues would have happened, clients would have experienced losses, and then you come in with a late intervention. Unfortunately, we don't really seem to find a way to move faster, but I think that one way is to just create a bigger general awareness of digital financial services rather than aiming to focus on particular types of fraud, which is what we probably were doing in most of the time. You see an incident and you say, okay, this is what is happening, but if you take that approach, then you become more reactive than proactive. So creating just a bigger awareness of digital financial services, I believe, will eventually resolve that particular issue. Thank you.
Lucia, anything you want to add to that discussion?
It takes resources, we all agree, but some good practices include having risk registries that map information threats and have technical control safeguards already defined for the different scenarios to accelerate the intervention and management. It's not necessarily cheap. It takes resources and skills, but it's a journey.
And I'll add to this, from the cybersecurity angle, one of the possible solutions would be to have more sharing. If you've been hacked or if you've had a threat, can you make that knowledge public in order to help others in your sector not be victim, and then ultimately your customers not to have their accounts compromised? But the competitiveness among the different actors in the same market does seem to be something that prevents the ecosystem from cooperating. But that will lead us to our more hopeful question, and then we are going to do some Q&A, and because we are interested in solutions, both for the financial service providers, but also for the ecosystem, we're certainly hoping that you're brainstorming as you're hearing this, and we'll join this discussion. But Eric, I'll start with you. So we have just talked about some of the challenges. if we do create a responsible digital ecosystem, and now you can have a little more time when I cut you off before, what does that look like? And how do we know when we have a successful one?
Well, for me, the success happens at the consumer level. That's the most important. So I'll be happy with, how responsible a digital finance ecosystem is once consumers understand, the terms and conditions, as you said, once consumers can complain if they have an issue, once consumers are getting products that are really adapted to their needs. So all these kind of things, and when they know how to deal with the fraud, all these kind of things. So what I would call these customers' immediate outcomes in their financial journey that you were, describing also earlier. That's what I would say is the ultimate results. Now, what you need for that is the ecosystem to function really well. And just some examples of what I mean. I'd love to see, for example, in every country, a strong collaboration established between data protection authorities, financial sector authorities, telecommunication authorities, consumer protection authorities, so that they put their strength together in solving some of the issues and in enabling, the right regulation and supervision. I'd love to see, more collaboration among providers. We have some examples, in several countries of industry associations that are working together to, find solutions for consumers, better protect them. So, this is a whole ecosystem. So we need everybody to work together. So I'd love to see different collaborations also among these different types of actors between consumer associations, regulators, industry players, international organizations. Ultimately, I want the customer to have positive outcomes.
And Jack, if you think about that generally, and then you think about Zambia in particular, sort of where the ecosystem is now and where you'd like it to be, what would be a successful vision?
Well, I think it's not so much different from what Eric has already alluded to. So maybe I'll just continue from there and say, from my perspective, I think that the success of digitalization is when we really begin to see the end users being much more confident in using the platforms that we are providing to them, knowing that they are safe, and also knowing that if they have a problem, there's a clear mechanism of expressing their frustrations. I think that will be really key. And this, for me, is not a one institution approach. It's an approach that requires a lot of collaboration among the key industry players. There is a role we can play, obviously, as a financial service provider, which I believe or hope we are doing, but we also need to see other partners doing the same to ensure that we create confidence in the system. And I think earlier I spoke about the steps that we have taken as an institution to investigate some of the fraud, and where we identify that it's not a client's own fault, we have gone ahead and made those refunds. I practically have been, I have had the opportunity of meeting some of these individuals who have reported a fraud, and going to them and seeing the impact that that potential loss has, and the joy that comes when they see that the institution is willing to pick up the loss, brings back the confidence into the system. And if we can have more of such actions being taken so that people can see the bigger picture and use more of these services in a safe manner, I would say we would have made great progress in improving client protection.
And this causes me to reflect that in these answers, there wasn't perfection. So a successful system is when you have fraud, you can react well. If you have a complaint, you get a resolution. And I think that's important to think about as stakeholders, is that that's realistic. It's like good management. Are we on top of it? Are we in touch with our clients? Not that we've eradicated any difficulty. But it is almost time for Q&A. I'm going to ask each panelist to just, we have a key takeaway slide, so we'll see if we agree with ourselves here, if we give you some surprises. But if people walk away with this discussion on DFS and consumer protection with just a few key ideas retained, Lucia, what are your ones that you want to make sure they are thinking of?
start before you're perfect and aim at gradual improvements.
You cannot overtrain the customer. Do as much as you can. Thank you.
I would say incredibly important to understand the situation of consumers and their experience in using digital financial services, and then actively seeking, collaboration with other stakeholders in the ecosystem.
Okay, so now it's your turn. We have about 15 minutes reserved for your questions and answers. We'll take several at a time. I don't know if we have a mic. Do we have a microphone to? So yes, please raise your hand if you'd like to ask a question or share an observation or help us brainstorm about how to construct a more responsible ecosystem. Whatever your contribution is, we're all ears. Anyone? If not, I have a few more questions for our panelists. We wanted to let you contribute. Okay, well, while you're thinking then, this gives me a little time to talk a little bit more about some of the areas that we haven't touched on yet. So we've talked briefly about cybersecurity, we've talked about fraud, we've talked about prevention of over-indebtedness. What about adapted products and services? So this is another area where there's a huge upside, but also a risk if you give people products and services that are not adapted to their needs, or channels that are not adapted to their needs. And so I wonder if you have any experience, and maybe Jack, we can start with you. What have you learned about sort of the risks of providing a product that doesn't match the need, or the benefits of adjusting?
Well, yes, that's a real risk that is always there, especially when you have big ambitions as an institution to digitalize. There's always a risk you over-digitalize the processes and create certain services that are not always reflecting your clients or your customers' needs. But in the practical example I can give for our institution, for example, at this moment, we have taken a step to ensure that all the services that we are providing on digital platforms are only being limited to the USSD platforms. And this is for many reasons, because when we did a small study of our type of clients and the gadgets that they have, we found that very few had access to actual smartphones. So building solutions that were mobile application based obviously was not going to speak to the type of client that we have. And we have also found that because of the simplicity that comes with USSD platforms, even those clients that don't have a lot of literacy in terms of reading or writing can understand the basic instructions that we are providing on those services. We've gone further to even look at just how the customer journey is designed on those USSD. If you have had an opportunity to use a feature phone, you can appreciate how difficult and complex sometimes it is to use just to move from your numbers to your letters. So when we are designing our digital services, we are mindful of those small things, because we're thinking of a customer holding a small phone, and then too many steps involved might mean that that product is not really appreciated. So I think it is very, very key to understand your customer and always have the customer at the center of every product design. If I have a second, I can also add just one more last point. So currently we are in an interesting stage. We are now also working on a new digital service where we want to build a platform for our village or rural clients to save using mobile technologies. And we just initially adopted this concept of having multiple signatories to approve a transaction. Then we discovered that these clients were not really able to come into one place and perform those transactions. It seemed like the right thing for us to do at the time, because that's what we thought was going to work, but we have had to go back and change that product, and now we've limited to just maybe one group leader making the transaction. It's always a trade-off between, is it going to be more risk or safer? But now this is a system that all our customers are quite happy to see, because it saves them in the kind of environment that they are. So I can give more examples, but I guess in the interest of time, I just want to emphasize that it's always key to think about that customer as we design our different digital products. Thank you.
Does either one of you want to add to that? Yeah, let you go ahead.
A quick another example, also related to a reality at the customer shop. The example of a fintech working with SMEs and the package including a digital loan plus a POS machine, where the theory was that by transacting through the POS machine, digital footprint would improve so that loan amounts could improve in future, except that for 80% of the clients, the POS machine was remaining in the box because there was no one to help with the installation and with the instructions after sale on the use of the technology.
I see a hand in the back, so yes, let's have some discussion, please. And please say your name and your organization before you state your question.
Tim Ogden from the Financial Access Initiative at NYU Wagner. I'm wondering whether people would agree, I would sort of characterize there's sort of an arms race. There's the arms race of the financial service provider AI figuring out how to extract the maximum price from the customer based on their data trail. The arms race of the AI for the customer benefit, finding which is the financial service provider that's going to offer them the best product so that they get the cheaper product, and the arms race between the fraudulent people pretending to be the financial service provider offering to get them the best price and really just stealing their money. Who wins?
Well, I will say something there, which is I think that question leaves out a key element, which is trust. So we had thought that if you publish your prices responsibly and everybody is totally aware of what's the more expensive one, then people would gravitate toward the least expensive, most adapted product. And that is not the case. So some people do, but there is still an element of what's my sister doing, what's my mom doing, and so that does change behavior to be a little bit less logical than what you just described. But I'll ask my panelists, do you see that tension between AI helping with sort of profit maximization and AI helping with better customer protection? And then, you know, we hope the fraudsters don't win, so let's not vote for that. But what do you think?
Well, I'm not entirely sure that AI is, you know, helping a lot of low-income and digitally illiterate consumers. I am convinced, though, that there will be more risks with AI for consumers, more new risks, more types of risks, for example, with the use of, you know, voice, you know, AI replicating the voice of your sister or brother and calling you up to ask you for a transfer or something like that. So I think we'll see more risks, but I'm also seeing opportunities for AI to reduce risks for consumers. We've done some research, for example, in India, using natural language processing to analyze social media with the intention to better understand the risks associated with consumers' use of digital credit apps. And it gave us an incredible amount of information, both on the nature of the risks that people were getting into, but also it gave us information about the actual institutions who were doing wrong. So, you know, it's going to be, we'll get both sides of the coin with AI. But again, I'm not sure this is going to serve directly our low-income, you know, digitally illiterate consumers.
Did anyone else want to respond? Or okay. So if you have more questions, please raise your hand. Yes, right here.
Thank you. I'm Ed Jimenez from the Philippines. This is a question for Eric. I hope it's not a stupid question.
There's no stupid question.
No. I'm just wondering, because you're from CGAP, you would know that countries that would, or jurisdiction that would have, or have already approved regulations or laws on consumer protection. Basically, my question is, has there been much improvement when those laws have been approved? The context of reducing the number of frauds. And if not, I really don't know the answer. And if not, what should be done? Because you're from CGAP.
Thank you very much. And it's true, the Philippines has just passed a financial sector consumer protection law. It's relatively advanced, I would say. Rwanda has also done the same. We think at CGAP that this is, you know, good news, and that this is, you know, the political and the policy, affirmation of the need to take action on this front. So personally, I'm pretty convinced this is going to have good, impact. I don't think there is any measurement at the moment, of the impact of such laws or even, regulations on consumer protection. But frankly, I see them as part of the basics that need to be put in place. And I think if you don't have regulations and supervision on financial sector protection, I think that's really a dangerous situation. So there are still quite a few countries who don't really have the basic, institutional setup and the basic regulatory framework or supervisory framework for financial consumer protection. And I wouldn't like to live in those countries because you don't have any, legal sort of system that protects you at all.
Just a comment to add to that, and I do agree with Eric, it's a basis, but I was working with a country recently where the regulation requires that financial institutions, all types of financial service providers, to have a complaints mechanism, and so they do. And we were saying, you have a problem with complaints, there's not satisfactory resolution. Your customers through social media, we know, are not happy. And they were saying, well, we are in compliance with regulation. We have a number they can call, so we don't have a problem. And so that's a bad use of, if nobody's calling your line, even if you have it, and therefore the regulator's not going to yell at you, it's not good enough. So there is sort of that necessary but not sufficient, I think, component to regulation.
If I may add, this is exactly the notion of outcome that we're talking about. And an increasing number of regulators are actually creating regulations that are requiring providers to show that the consumers, can complain, are actually, able to complain and understand things. So regulations also need to be geared to measure that kind of outcome.
Okay, any other questions? Otherwise, I have one more question for our panel, but you guys should take precedence. Yes, here, please.
Hi, yeah, Rebecca Rhodes from Gogla. Just a question, really just playing devil's advocate. If you were, probably to Jack actually, if you were expanding into a new market, say, and you just wanted to make a step change in the way that you did consumer protection, even though it is very much a holistic process, what would be that one thing that you would make sure that was there and in place, the one thing that you would focus on?
Well, that's a very difficult question because I can imagine it's been a number of years since we started our digitalization journey. And I think that, like I mentioned earlier, when we started, the environment, the regulatory environment was not even there. And so when we were facing this fraud-related issue, we didn't have the kind of structure on how we should respond ourselves. We now have much more support from a number of partners, even the government, and the regulation around is much more stronger. So if we were going to start the same journey today, I guess we'll be starting at a much different level with much more support, and I guess our focus will be in other areas. And I think, honestly, at this point, what we've really found really helps is just to say how much information can we ensure the client knows about the risks that are related to this. And if they know that, then maybe they can take steps themselves to protect their transactions. So I, at this point, genuinely believe that you really need to design training programs or support mechanisms that improves the financial understanding that your customers have. It could be because it's maybe because of the type of client we have who are very rural. So we almost think we can never really overemphasize that point. Thank you.
Okay, everyone, we are going to thank our panelists and do our fun change now where we transfer from DFS to PAYGo Solar. So please join me in clapping for our panelists. Thank you so much. And Jack and Eric, you can have a seat, and Puck and Jean-Baptiste, please come up and we'll change name placards. Okay, so that was quick. Well done, everyone. Now we're switching our hats and we're talking about PAYGo Solar. So let's take the slides and meet our speakers. Jean-Baptiste, I'll start with you. Please introduce yourself.
Okay, I'm Jean-Baptiste LENOIR, co-founder of Qotto. Sorry. So I'm Jean-Baptiste LENOIR, co-founder of Qotto. Qotto is a SHS operator in West Africa. We are implemented in Benin, Burkina Faso, and Ivory Coast.
Thank you. And Puck?
Hi everyone, Puck van Basten, Project Manager Performance and Investment at Gogla. We're the Industry Association for Off-Grid Solar.
Okay, so once again, you have some nice slides in our presentation where you can learn more about Qotto and Gogla, but we're going to get straight into our discussion. And we'll start now, so this is a different sector from microfinance or financial inclusion. And so Jean-Baptiste, I'll start with you. Can you tell us, please, what are the key sort of differences and challenges in the PAYGo Solar sector?
Yeah, PAYGo
and
Solar.
You just need to turn on. There you go.
Yeah, PAYGo Solar, basically, our mission is to provide access to electricity in rural areas to vulnerable people. In Africa, that's 600 million people today, so we still have a lot of work to do. It's the SDG 7. It should be solved by 2030. We're far from it, so everybody's welcome to help us. But the first challenge of giving access to electricity is to make the access to electricity accessible. Accessible, it means two things, technically and financially. Financially, we make it accessible through pay-as-you-go. So it's a digital financial services, so we have the same challenges that the panel before just described. It means that we have fintech, we have Internet of Things, we also have machine-to-machine technology in our systems to make it efficient and digital. So that's a lot of training for our sales forces as well. But maybe the main difference with the previous panel is that we provide a hardware to create electricity from solar and to provide this electricity to our households. And technically, it means that we deploy, to make you understand, it's a solar panel the size of this table, a black box in the house that manages both energy and communication. And we have also batteries and bulbs and cables and switch and TV and fridge. A lot of hardware in the customer premises. So this hardware is probably the main difference. And I realized when I heard to the previous panel that it's a challenge for us, but it's also an opportunity. It's a challenge because we need to have salespeople in the field. We need to have after-sales services in the field. We need to have logistics. If you want to move such a system from your warehouse in Cotonou or in Ouagadougou to the countryside of Dédougou or Parakou, it's logistics. You need a truck or a car, and then the technical guys that will install in the customer premises, they need a motorbikes or a car even, okay? But for me, it's also an opportunity because our customer, they pay only through mobile money, okay? So in our company, everything is digital. It means that when they pay for the systems, it automatically switch on the system. If they don't pay, it switch off. So what the service we deliver is daily renewed. It creates a lot of trust. Trust is the word that I heard the most in the previous panel, but this is where the hardware is very useful for us. Every time the customer pays, you see the lights going on or the TV going on. And then, compared to the frauds you can have, we realize at Qotto that this customer satisfaction, the fact that every time you pay, you have the service, it's very, very important. And it's a lot of challenges for us. Huh? We need, as I said, logistic, but also after sales. It means that when we have a problem with a bulb, the customer call our call center, we answer to the person, we understand where he lives, thanks we have his position, we have his phone number, and we send someone to solve the issue for 3 years. So that's, I think, in the PAYGo industry, one of the big challenges is to have those operations with hardware working properly. It means that we need to have a lot of trainings for ourselves to explain not only the digital financial services, but also the technical. How does it work? We had some people putting the solar panel inside the house to avoid them to be stolen or to be damaged. So we have to explain that it must go under the solar. But you see that it's not only digital financial services that we need to explain, but also technical challenges that we need to explain to our customer. And also, we need to have trainings with our sales to be sure that they provide the right information, technical information, to the customers, and to our after-sales services to be sure that when we pay them to solve an issue within a customer premise, that this problem is solved and that the customer is satisfied.
And this also, when we were talking earlier, another challenge is with the staff because they're doing sales in the field, and that's incredibly difficult, and that's different from microfinance. So can you say a little bit more of those challenges too?
Selling in rural areas is a very tough work. Every time I go in Benin or in Burkina or in Ivory Coast, I spend time with the sales team. It's very difficult work. You are under the sun. You go on door to door, and you try to sell something very different from what the people had. You offer a solution, but you have to explain all the challenges I just said before. One of the challenges for us is to have the same team along years, because we spend time on training them, but also not only on selling, but also on portfolio management. As I said, it's a pay-as-you-go model. So if we want to have good repayment rates or payment rates, we need to create a strong relationship and a strong relationship with the customer. And it's the salespeople who will do that. And if the customer is not paying, we need to understand. Is it a technical problem? Is it a financial problem? Is it maybe you don't have a work for some time, or the harvest were not good, or a bulb is not working, so you decided not to pay anymore? So this request to have salespeople in the staff for many years. Unfortunately, as it's very, very complicated and very tough work, we have turnover in our sales teams. It's around 30% per year in our teams. It means that we need to train the people and to change the whole staff every 3 years, basically. But we need to train the new staff every 3 years as well.
Okay, that is daunting, but we'll pause on that and come back to some solutions in a bit. Puck, we're going to come over to you, and this is part of the solution to the overall issue. There is a consumer protection assessment tool, so good news. So please tell us all about it.
Yes, thanks, Jean-Baptiste. I think you already started on some good practices that we will talk about later. But maybe to start with, I think it's really important to say that we really believe that without the PAYGo model, a large part of the bottom of the pyramid customers would not have been able to access these products, as Jean-Baptiste was alluding on, but that's really something that I want to point out. And yeah, I think they have to make a down payment, but then afterwards, of course, they can make the installments over a daily, weekly, monthly basis. But even more so, I think we believe that, as Jean-Baptiste was also saying, it's not only financial risks that come to customers, it's also product risks and service risks. So as an industry, I wasn't there, but I'm going to pretend that I was there.
It was all you.
Back in 2018, everyone put their heads together and thought, okay, what can we do? We took a lot of learnings from, the MFI sector, as of course it's a sector that has made steps, way before us, and that we, in many aspects, take learnings from. But in this particular case, from the SMART campaign, we looked at the client protection code that was developed there, and we came up with our own consumer protection code for the off-grid solar sector. And I think again, it's quite similar to the one that exists in MFI, but here, for example, we also focus on product quality. So there's an indicator that says all the products have to be quality certified by a Ferrosol. It's called the the association who arranges that. But we also, for example, focused on e-waste management. So that is definitely, topics that you won't have when we only talk about financial inclusion. So we have to make sure that's all incorporated in this code. So we have 6 principles in the code with 37 indicators. It also comes with a self-assessment tool. So if you make a commitment to the code, we require all companies to do an annual self-assessment. So it's really internally. And of course, with the self-assessment, is it right what you find? You might be a little bit generous to yourself. So we were also thinking what could be the next step that we can take. And that's when we joined forces with MFR to develop a third-party assessment. So that is really a objective, independent assessment that companies can use to find strengths on the one hand side, which should really not be forgotten, but also points of improvement. And that is really something I want to point out here, that I think I heard someone yesterday saying on the client, the power of the client voice. You don't do a survey because you want to get a rate or a score. You do it because you want to understand your processes and you want to understand, in this case, the customers, but your operations, what can I do better? And that's really what this assessment is for. So to find points of improvements and then with MFR, make a prioritized, detailed action plan. So what can we focus on? Because that's what Jean-Baptiste is also really going to say. You cannot do it all at the same time. So what can you do? And how are you going to achieve that?
And just a point of clarification, the self-assessment still possible, correct?
Of course, yeah.
You have the free tool you can use, but then there's also an external assessment.
Yeah.
Okay,
Yeah,
wonderful.
that's correct.
Okay, and actually so we'll get more into that, but Lucia, so you've started using the tool, and now you have a view, sorry, I lost my mic. You've started using the tool, and you've had a view of the different challenges that different entities have, and just to reiterate what Puck just said, everybody has challenges. So when you do your evaluation, and you yourself also have gaps, you just join the club, everyone does, but as you think about the database as a whole, what are the common challenges that you've sort of analyzed and seen?
Very well, and let me first start recognizing that PAYGo off-grid solar companies are doing very difficult work. And if I compare the target population served by PAYGo off-grid solar companies to the average microfinance institution, please have it clear in mind that the segments served by PAYGo off-grid solar is far deeper, more rural, more excluded than the average we have in mind at microfinance institutions. So with this in mind, there are consumer protection risks. We are very happy to have a tool that is guiding companies and investors in improving, which is really the goal, not much to demonstrate, but really to have a collaborative approach. One area that is very critical, and it is the two sides of the medal, consumer protection and profitability, is responsible sales. And so it is very difficult to be a PAYGo off-grid solar company. You need to be good at technology, you need to be good at distribution and logistics, and you need to know about credit risk management. The 3 hats that you need to wear. You inevitably are born with a DNA, which is often the one of retail distribution, and so how do you incorporate that culture of credit risk management? That is one of the challenges. Good practices that we see in doing this include going beyond the fact that consumers can make the initial down payment and also doing some analysis of client repayment capacity, even if it may be difficult, at least for the small systems, to do it at the level that a microfinance institution would do. Very good companies, like in the case of Qotto, also employ a call center, which is a powerful second factor and independent line of defense. So you have the sales agents under the sun in the field doing one of the hardest works, but then you also have independent vetting from the call center, verifying that clients understood terms and conditions, battery use, product care, what happens if you miss the payments, and doing the analysis of over-indebtedness as well. Supervising agents on the ground is extremely important, even if extremely labor-intensive, given the agents' turnover. And one thing that is powerful is also providing your agents, which are typically very close to the socio-demographics of your clients, so often not necessarily literate and not at all stupid, but you know, and so providing visuals of how to recognize segments of clients to sell the right product to the right segment is also something that helps, along with scripts that can guide non-aggressive sales.
Okay, so let's continue that topic. Puck, I'll turn to you. You guys did some research on agent management, and everybody loves a good horror story. So let's start with when it goes wrong, what happens, and then we'll get into some solutions. But please share what you learned.
Yeah, I think some of the things I wanted to share have already been shared, but I think indeed one of the main things is that, agents kind of have to do it all. And maybe one thing that is important to mention, I think, is that they do work on a mainly commission basis, so they want to complete the sale. So they travel far, they have to do it all, and they have to make the sale to get the commission. So I think maybe from there, we have to think about the incentivization, because for now, I think we see that some companies are already experimenting with what kind of models can we work with. I think also from the beginning, the main focus have been on sales, fast growth, also from the investor side upon the companies. And luckily, we see now that the focus is shifting more towards consumer protection, portfolio quality. So I think from there, we really have to think, okay, what can we, what kind of incentivization models can we use? So again, taking learnings from the MFI sector, I think we see that purely variable models do not always work. So I think companies, as I said, are experimenting with hybrid models or fixed versus variable models. And I think maybe if what we also saw in the research, again, related to turnover, is that companies struggle a bit with agent retention, and that agents sometimes perceive to have a lack of opportunities for professional growth. How can they, they see it as a transient or short-term job. So I think that's something also companies really, would be good to think about. And maybe to share a good example, not a horror story, but when I was in Uganda in May, we actually went on a field visit with a company, and we saw that we met an agent who is now the regional collections officer, and he started as a sub-agent, so someone who's really not even recognized by the company, and he really, grow up all the way into the company. And I think these kind of stories are really good to share. And I think sometimes it's also really easy. I think from the research we also saw that small rewards like supermarket vouchers can have like this great impact on agents and make them feel valued. I think that's something that maybe should be emphasized. They want to have the feeling that they also mean something for the company, and that also comes with the right compensation and incentivization.
And that's actually a lesson in the universal standards as well as there's sort of a connection between treating your employees well and then how well they treat your customers. And we're exploring now in this digital concept how much of what we apply to employees also applies to your agents. And there is a large overlap. But let's go to a real example. So in agent management, what are your observations from having had to do it for years? And please turn on your mic.
Yeah. How we manage the agent at Qotto?
Yeah.
Okay, so at Qotto, as we said, trust is very important. Trust is one of our value, because actually we have trust at every stage of the business model. Trust, we need to trust the customer that he will pay for 3 years first. The customer has to trust that the equipment we deliver is good and that we will serve he or her for 3 years. But you also have to trust the agents that they deliver the right information on the digital financial services and on the electrical, let's say, services to the customer. So how do we manage that with the agents? We first train them a lot, for sure, but we also give them incentive to have sales, but good sales. And this is something that we need to put in the culture of the company. Good sales is very complicated in our business model because, as Julia said, 61% of our customers lives below poverty line. So we need to really make our agent understand what he is selling to who, and to be sure that what will be sell to the customer is useful and is adapt to his capacity to pay. And here it's quite complicated. You need to understand very well the customer. Sometimes we have people who are very, very, very poor, but the system we deliver will generate revenues. So in that case, the revenues generated by our system are far bigger or larger than the cost of the system. In that case, we have very, very good repayment. And sometimes, if the agent didn't understand what is the business of the customer, and if he's just here to make sales, then we will have big problems afterwards. And once again, as we deal with hardware, it's an asset that we need to make it profitable. We could see like we want to make every asset profitable, so we need to do a repossession. This is very complicated. We need here again to involve the agent because he did the sale, and so now he has to deal with the repossession of the equipment. So for that perspective, we need to create smart incentive plan on sales, on payments, regular payments, portfolio management, and also repossession. So that's a lot of options that we have for commissions, but also a very good incentive for agents to manage their portfolio.
And this actually touches on transparency as well, because you want the customer to understand not only what something costs, but also how to maintain the equipment, what's the right way, what's the wrong way, not to put the panel inside their home. So there's, and you want the agents to understand what's expected of them, and that, ultimately just sale without reflecting on whether it's going to benefit the customer. Well, so transparency at every level in this sector, as in microfinance, very important. But can you say more about some of the challenges you've had with transparency?
Transparency, as I said, it's for most of our customers, everything is new. Whether it's even sometimes mobile money, it's new for them. Then if you need to, they have to understand the PAYGo, they have to understand the system of electricity. So this requires a lot of training at the beginning, but also to control what is the level of our salespeople. This is somewhere we need to work again at Qotto, because we know that we need to improve the quality of the information that our sales deliver to the customer, but we also need to create loop to check that the information is properly delivered. For example, our call center always call back the customer after a sale and have a little questionnaire to understand if the customer understood properly how it works and how it doesn't work, and also to ask some questions to be sure about that. Once again, one of the challenges here is not only the message, but also the way it's delivered. Most of the time, not most of the time, but very frequently, people are illiterate, and it's complicated because you have a box at the end of the day. You have the box in the house, deliver information about how it works, how it doesn't work. So here again, we need to educate the customer, and we need to adapt to the challenges of local languages. both for the call center, but also for the customer.
And this is important also when I talk to Jean-Baptiste. Oops, well, I guess we'll have some thoughts from the ceiling.
Dear participants, the sessions are starting. Please go to the rooms.
Okay, wonderful. You're already here. This is reminding me of the connection between transparency and customer satisfaction, which I think we don't always say those things in the same sentence, but I'm reminded in my microfinance hat of a time when clients got a savings product and it was their first time saving formally, and they all a month later were very dissatisfied because they'd been told that the savings product earned interest, which it did, but the interest they got was tiny, and it came to light that they realized they thought they were going to get the same amount of interest that they had to pay the loan sharks in their own village when they took out a loan. They thought interest was interest, and so they had imagined, you know, a really nice return if they just saved formally, and then they didn't get that kind of interest rate, and they were very upset and didn't want to use the product anymore. So, and I think the same in this sector, the less transparent you are, the more dissatisfied your customers are ultimately.
Yeah, I think customer satisfaction, transparency, trust, and customer protection are very related, actually. Yeah. For Qotto, the more the customers are satisfied, the more they pay. I mean, we are all the same. If you have an internet access, if it's not working, you will not pay for that, for sure. It's the same for electricity in rural areas in Africa. But so to work on customer satisfaction, that is overall goal of Qotto, it goes through trust, also through transparency. And I think that what is good at the customer protection, it really drives us to reinforce the trust with the customer and then to create this virtual cycle, we can say that, yeah? Yeah. And to reach profitability, for example, for PAYGo Solar.
Puck, anything on your research side for transparency to share?
Well, I think we covered it all, and maybe just to add and to relate a bit back to the previous topic on agent management, because maybe in that sentence we also should add agent management, because they are the ones communicating. And I think as Lucia also shared a bit earlier, we should not forget that often also the agents might have indeed a similar profile to the customers, which is of course super advantageous in the way that they do speak the local language, they have an easy time getting in touch with everyone, they understand the challenges, the needs and the behaviors of the communities, but also they have to be trained very well on digital, financial, any literacy, and all the topics they have to work on. Maybe one thing to add that you should also think about who to educate, because I think what we sometimes see is that the contractor, so the one actually, signing the contracts is the male, so the main, well, I don't want to say it, but the household main. But the one who is actually using the product or the service is often the female. So whether the agent comes to the house to explain everything, make sure you really maybe involve other people as well. Or if you do want to call them up, you might have the primary contact number who is from the man, but maybe as a company, make sure you have a secondary contact number as well. So really think about, okay, and I think this comes down to context and understanding, of course, the impact of a product, but who is using it and who should I educate and talk to. So that's maybe one thing.
Yeah, we have not the same, but in microfinance also, it's very common that that the woman applies for the loan and then the man ends up deciding how the money is going to be used. And in your case, you're talking about educating the man, but then it's the woman who uses the solar equipment in the home. So different problems, but fundamentally knowing who actually has an influence over how that product is used is really important. Lucia, did you want to add anything to the discussion?
Yes. You know, it's also about what incentives agents have to be transparent. And at Qotto agent turnover is probably better than in the industry average, where we have seen that the combination of transitionary job perception, very hard work, and not always making a living with the compensation from sales, because not everyone is good at selling, makes it that you lose your agents even simply after 1, 2, maybe 3 months. And recent analysis of portfolio quality by cohorts showed that in the beginning of the receivable contract, repayment variability is very high, but after month 3, the repayment performance starts to stabilize and to correlate to the ultimate default risk of that client, which from an agent incentive scheme perspective means that if you are able to keep your agents after month 3, it means that that is when your incentive scheme really starts to make sense and to be to have teeth for your agents. We heard from many companies, you know, I tried many types of different structuring of the incentive scheme and even of my way to assess client repayment capacity, and none of this works, and I still have a collection rate which is way below what I need it to be sustainable. And so this is also because in addition to the tools, it is about making sure that your sales force stays with you long enough for your tools to be effective and stays long enough for your training efforts to be worthwhile.
Okay, so we're going to wrap up, so it's about to be the Q&A portion of our time with you, so get your thoughts together for that, please. But I'll just ask each panelist, and Lucia, let's start with you. Final thoughts, and again, we tried to put some of our key lessons learned on this slide so that if you download it later, you don't have to memorize what they're saying now, but key takeaways for you from this discussion about PAYGo Solar and consumer protection.
It is big responsibility that PAYGo Solar companies have on their shoulders, and it is great to seek partnerships when possible. I would mention one example, which is unfortunately for now more the exception than the rule, but to inspire, it is the example of the Baobab Group. So there is the Baobab Financial Services and the Baobab Plus branch, which is about PAYGo Solar. And so because of the proximity between these two companies, which belong to the same group, they have recently started, each one specializing on what they do best, so that the PAYGo Solar company distributes kits and takes care of the after sale and the technology, while the financial company takes care of the initial credit risk assessment. Why we haven't seen this more, which in principle makes sense, and you know, to have a coalition where everybody specializes, still to be discussed. It has been tried many times. Unfortunately, financial institutions sell very little solar panels compared to what PAYGo Solar companies can sell with a PAYGo payment model. And so growth has been huge in the PAYGo Solar company segment, while it has been very low when you give simply solar kits as a credit line available with financial institutions. But it doesn't mean that it is not worth to keep on trying and building those partnerships.
Okay, well, yes, why don't we take you second? No, it'll be logical, and then Puck, you'll close us out. So please, key lessons, Jean-Baptiste, what should we retain?
Yes, regarding the partnership with MFI, I think it's very important for PAYGo Solar as well. We know that consumption of energy and wealthiness is totally correlated. I mean, it's been demonstrated for many, many years. And what we see at our level, I mean, when a family has access to a system that is powerful enough to cover his energy needs, simply for charging a mobile phone, which costs 100 francs in West Africa, a system to charge the mobile for the work family, for Qotto it's 300 francs, so you can charge 3 phones, but once you have 3 phones like that in the family, you cover your cost. You can also create services that will generate money. So what I mean here is, if we want to have satisfied customer and to increase the customer satisfaction, we need to focus on what we are good at. At Qotto, we are an operator. We want to be excellent in operations, meaning good, very excellent systems that can last for long, that they will deliver a very good service to the customer, very good after-sales services to keep customers satisfied, and also, as we have a very strong digital infrastructure, we manage everything digitally, including mobile money. But on the other side, I think we would benefit from expertise from MFI regarding credit scoring, regarding also financing the customer. And as soon as we can focus and put all our energy in the operations, I'm sure that we can create something very efficient.
Wonderful.
As Baobab Plus did.
Right there, we have one example of success. And Puck, final thoughts before we have questions?
Yeah, I'll try to keep it simple and relate to what Jean-Baptiste said as well. If you want to grow and be a sustainable, responsible, and profitable business, you need happy customers. And happy customers often starts with happy, well-trained agents. But for that, as may have been clear, agents and both OGS companies have a hard job. So they need investment to actually execute these trainings. And we have some tools in place. We, as the industry association, have created this tool that companies can use. But that's also only so much we can do. So we need everyone. May not be a new message, but yeah, we do need buy-in from more stakeholders to really make sure companies have the resources in place to actually act upon the things we discussed and make sure that we have good consumer protection practices in our industry.
Okay, now is your chance to ask our panelists your questions. So please, if you have a question or comment, right here, please. If you can come all the way to the front, we'll start. Because it's recorded, so they need you to speak for all our friends in the Ethernet.
My name is Birgit Rauleder. I'm a consultant from IPC. First, thanks a lot for everything that has been said on this panel. I have worked with several PAYGo providers over the last years, and it's the very first time that I listen to be recognizing that you provide loans. I had very interesting encounters in this sense, and I'm very glad to listen to you saying now it is recognized that you are providing loans and that you have a portfolio and that you need to do portfolio management. So this is indeed great progress. And yeah, what I find indeed curious, Lucia, is indeed what you have just said with the example of Baobab. Indeed, Baobab has a great pain to get this up and running, and I'm still wondering why is it so? Because Jean-Baptiste, indeed the challenges that you have running the business, they are harsh. It is not an easy job to make ends meet. So indeed, why would not more microfinance institutions recognize the interest for such a cooperation? Thank you.
Risky. Believe it or not. Okay, so microfinance is good at filling gaps. Where banks don't go, microfinance comes. But microfinance is sometimes regulated. Microfinance is mature, it needs to be prudential. By definition, solar needs to go off the grid. Off the grid is costly to reach. It can be 5 hours drive, and it is risky to repay. When you compare repayment, when you compare the combination of par 30 plus write-off in financial inclusion and in PAYGo, it is, in PAYGo, this level of credit risk on average is from 2 to 3 times higher, to give you an idea. So these companies are dealing for a number of reasons: technical reasons, financial reasons, vulnerability reasons, non-specialization reasons, with clients that represent a much higher credit risk that many microfinance institutions are not interested in taking. It is also a matter of skills, and it is not the same to sell a loan and to sell a solar equipment, where you also need to teach the users on how to use the system, how to keep the batteries in a state that they can last, the lockout technology, and how to make payments. There has been both models of having financial institutions financing and solar companies only distributing and so selling cash, and having the PAYGo model, where solar companies at the same time make loans and sell. They both coexist in Asia and in Africa, but unfortunately for now, the specialized model, and so the one where solar companies only distribute and take care of after sale and financial institutions do the financing, has been growing much, much slower.
Cecile, did you have your hand up? Yes.
Just maybe on that, I think it's also a trust issue. We had the opportunity to sign a couple of contracts with MFI. Usually we have a very clear understanding at the top level, and it's very easy to sign a contract with MFI. Frankly, I was very surprised that it was that easy. But when it comes to agents in the MFI offices in the countryside, it's much more difficult. We had a lot of MFI agents who took our system for themselves, so it's not a problem of trust in the equipment of the service. But when it comes to sell it to one of their customers, they were very cautious. Complicated to understand if they don't think that we will deliver the service as well as they want for their customer, or if they are ready to take the risk for their customer. It's something that we need to be, probably we need to work on that, because as Lucia said, a company that has the two legs, Baobab and Baobab Plus, they can make it very, very efficiently.
Thank you very much for these inspiring cases. It's nice to see that the experience of the microfinance sector and universal standard can help also and inspire new sectors. I was wondering if we can go even a step further when, Perk, you were talking about tools and support. On the universal standard, we have a wide range of technical resources to guide on each and every standards and practices. And you have driven some of your standards from these. You have new standards also specific to the PAYGo models, but could it help also on human resources management to share those resources on selection of clients, on prevention of over-indebtedness? There are plenty of complaints mechanisms, plenty of technical resources available that have been developed for the financial service provider, but which can inspire also the reflection on decent work condition, maintaining staff, reducing staff turnover, and things like this. I think we can maybe push a step further the inspiration among sectors.
Yeah, if I just can quickly respond, I think we beyond just the tool, we definitely do that. We also have a consumer protection toolkit, and for each of the principles, we provide guidance for our member companies, and definitely we take learnings. From the last session, we are actually now working on consumer protection risk specifically for women consumers, and there again, many of the things that Eric was sharing, we took as a learning. So in some way, we are very happy that you were before us in many different areas, and we can learn from your mistakes, but mainly from the good practices that you show. So, but if you have specific examples, I'm happy to hear afterwards. If you can point us to different things, yeah.
Okay. Yes. One more here, please.
Hi, this is Thijs from FMO. Just thank you indeed for the very interesting presentations. And it's really good to see that you're promoting client protection principles, etc. I was wondering where you also look the other side, namely at the sourcing of your PV installations. And are you doing something there to check that these have been produced under decent work conditions or are slavery-free? Because that is also quite an important discussion. Thank you.
So, Jean-Baptiste,
How do you make sure that the equipment that you sell is high quality and wasn't produced in bad-looking conditions?
Okay, I can respond for Qotto, but I know that Gogla is working a lot on that and represent the industry. So, and I think that even all the members, the Gogla members are certified and have certification about the quality of the equipment. But just for us, we have direct contact with our producers. We are one of the companies in the sector that is not buying from an hardware provider. We have our own teams in China making a quality check, and for working conditions, but also for equipment quality. After I hand over.
We have just 1 minute left, so actually we'll close with this 1 minute.
I actually wanted to hand over to my colleague Rebecca, who is more on this topic. So,
so raise your hand, Rebecca, please. We'll get you the mic. And if you can give us a punchy 60 seconds, and then we got to wrap up.
Yeah, so as Gogla, we do represent the industry as a whole, and when this originally came up a couple of years ago as an issue, we came together, and there was a big kind of stakeholder effort to really kind of understand what we can do as an industry and recognize that as the solar industry as a whole, we are a tiny part in the global PV industry. So our weighting on that front is actually quite minimum. But there are checks and processes that we advise companies can go through, and the funders also kind of understand what that is and really try and build on this ESG frameworks that we can do as a whole. That's first of all practical, but second of all, also useful and mitigates as much as we can the risk.
Okay, everyone, please, unfortunately, you're going to have to chat at coffee break. Please join me in thanking our panelists for that interesting discussion. And Anne-Laure and Thomas, now you can come up. Let's see if we can exchange placards with you again. Can you hand me the one for Thomas and the one for Anne-Laure? Yeah, either one. Thank you. Okay, all right, we'll be here. Okay, so now we get to talk about agribusiness. And we'll meet our speakers. We'll just jump right in. So Thomas, sorry, you don't even get to drink your water. You have to wait 1 second. But please introduce yourself to our audience.
Sure, thanks. Thanks a lot for having us here. I'm Thomas. I work for IDH Investment Management, the fund manager of IDH FarmFit Fund. We manage a 100 million blended fund that is focused on smallholder farmer transactions where we can take the highest risk and long-term debt in investments in smallholder-focused agribusiness and financial institutions, agtech and fintech.
Great, and Anne-Laure, please.
Yes, hello everyone, thank you for being here. I'm Anne-Laure Behaghel. I work for Cerise+SPTF as the Client Protection Pathway Director.
Okay, that's one of your hats, right? Because you're also very involved in agri. So we have the slide again on the FarmFit Fund. I want to draw your attention to this link at the bottom here. So we're going to be talking about the CP Agri tool. And again, if you download this, you get access to our resources. But we'll jump right into the discussion now. And as we did before, we'll start by first situating ourselves in this context. So now we're in agribusiness. And once again, although we have some overlap concerns related to consumer protection, there are also some specificities of this sector. So please share.
Thanks. Yeah, we are looking at agribusinesses and agricultural value chain actors and how they interact with smallholder farmers. So really farmers that have between 1 and 10 hectares, that have limited access to productive resources, and whom we think are probably the most vulnerable clients that are out there, that are facing disproportionate levels of financial stress, are exposed to climate risks, increasingly erratic weather, and that have generally limited access to services, financial services, but also other types of supportive services, transportation, knowledge, extension services, and that despite the fact that they are actually responsible for the majority of the world's food supply. So really they play a very important role and are among the most underserved clients out there. We look at them as clients in a very broad sense. So they do receive financial services ideally, but also they require access to markets to thrive, to sell their produce. They require inputs, and they require all types of other services that help them manage the various risks and difficulties in the rural context that they operate in. And because they require such a broad range of services to really, improve their yields and improve their livelihoods, it's also that they require a broad range of actors to provide them with these services. And so what we really see is that there's different types of agribusinesses that directly interact with smallholder farmers, from cooperatives to input providers, processors, traders, and all types of middlemen, but also financial institutions that serve smallholder farmers with loans, and increasingly also agtech, fintech type of companies that are well equipped to overcome some of the challenges that businesses face in this space, like information asymmetries, overcoming the long distances to serve smallholder farmers in rural areas. And something that we've observed is that a lot of MFIs, FSPs shy away from serving smallholder farmers because they're so expensive to serve. And because smallholder farmers require inputs and they require financing to acquire these inputs, increasingly agribusinesses are stepping up to actually finance these farmers. With that development, there are increasingly almost barter models where farmers are receiving inputs on credit that they repay in kind through the production that they sell back to an agribusiness. But there's also all kinds of other new business models that add complexity. We see digital marketplaces where different actors buy, sell services, where different off-takers can source, and where smaller farmers, I think, do not necessarily have the strongest bargaining power on. And we also see that increasingly agribusinesses are deploying agent models to overcome some of the challenges, like last mile delivery. And all of this is happening in a space where climate protection risk is not really something that is well understood, and where, well, the standards that we have in the microfinance industry, they haven't really permeated into, and that is, well, what we're here to talk about today.
So that was a lot of differences. I would say just to retain all these new actors that are involved, so we have to think about customer protection for everyone at all stages, the variety of the actors and also the new business models, and then the particularly high vulnerability of this sector to risk, including climate change. And then maybe less understanding of what consumer protection looks like. So we have our challenges and our specificities. And if we talk also about risks, so Thomas will stay with you. What are the main types of risk? And not all of them. Again, we don't have the holistic time, but what are the big ones that you're really seeing are affecting consumer protection in agrifinance?
Right. I think the first and foremost risk is exclusion, right? That we already talked about. But after that, I think there's all kinds of risks in terms of dependency, because the service delivery in those contexts is limited. So there's often just a single provider that farmers have access to, which creates opportunities for predatory pricing and for opaque cost structures. Services are often bundled together, so farmers can't really differentiate which service costs how much they're paying for the loan that they're taking out. Price is a different very important elephant in the room already. If you're looking at the agri space at large, you I mean, we can go into a supermarket today and buy a bar of chocolate for 90 cents still. So you can imagine that pricing and what ends up in the farmers' pockets, there's a big risk. Prices of inputs, prices of other services, contracts. Are farmers aware of all the contractual conditions in contracts that they're entering into? Are the contracts voluntary? Are they mandatory? Do they specify which party has which obligation? What quantity and quality of crops should be delivered? So there's a lot of unclarities there, and farmer understanding is a big issue. There's lots of opportunities for fraud along the value chain. So in terms of volume evaluation and quality evaluation, for example, there's a lot of issues with weighing scales that, like especially the manual ones, that offer lots of opportunities to tamper with, and where there's value capture by, for instance, agents. We've also seen that agents sometimes downgrade the quality of produce and capture some of the price and cheat the farmer out of their fair pay. Farmers are often not paid in time. Cooperatives lack the working capital to pay them on the spot. Sometimes they offer them interest for a later payment, but there's no guarantee that that will actually happen. There's no formal documentation for this. And then there's a whole range of issues and inputs, from the quality of it, the timing. There's fraud with input packages being refilled with lower grade inputs and then resold. We've seen lots of issues with also just insufficient quality of inputs, or inputs being provided with the wrong specifications, and then farmers still need credit for purchasing these inputs. And I think that is something where I'd like to give the floor to Lucia to talk a bit about more what risks there are on the credit side for smallholder farmers.
Please. In case you didn't have enough. Right. No, look, it is complex, but it is worth it. So complexity is also around, yes, repayments in kind and fair assessment of the quality, the quantity, transparent provision of receipts for the payments, ability for the farmer not to be captive of one off-taker, but to be able to decide to whom the produce will be sold. When it comes to the assessment of credit, in agriculture, it is essential to do crop cycle analysis of cash flows, but that needs to be complemented with also the analysis of the household income, expenditure, and existing debts to avoid over-indebtedness, also because it is not a space where we can afford seizing land as collateral, which would deprive the smallholder farmers from their number one income generating resource.
So yes, that was depressing, comprehensively depressing, but we are trying to now find some solutions, and that leads us to the Agri-CP tool. So Anne-Laure, please tell us all about that.
Yes, so together with IDH and making this statement of an untouched yet area in terms of mitigating these client protection risks, we thought about, like at Cerise+SPTF, we have this client protection, we have these standards for client protection, and how can we adjust them to fit better all this complexity. So our traditional tool covers everything that is financial services related, and we needed to go beyond just the financial services, because as you've just heard, there are a lot more interactions between agribusinesses and smallholder farmers. So we decided to structure this tool along the 8 client protection standards in order to keep a common language, because mainly we have the experience, 15 years of experience with these client protection principles, standards, and we could also pick from the experience and the well-recognized practices. So we picked almost 75% of the essential practices that apply in the financial service sector. But what we did is adapt rather the statements of practices to fit financial services that are provided by agribusinesses whose core business is not providing financial services, but just to help them understand what it takes to analyze a loan, to avoid over-indebtedness, etc., and to do collections in a fair way. We also address purchasing services, so the other way around, where the term client, in fact, applies to the smallholder farmers as a supplier of his products, where he can also be in a complex position, and some businesses could abuse their power on this. We addressed with indicators as well what's one of the risks that Thomas mentioned about contracts. So I have an example here just to give you an example of a specific indicator which says that the farmer is given the choice whether to enter in an offtake contract or not, and this doesn't prevent him from accessing other products and services. So this type of adjustment or enhancement to what we already have in the client protection traditional assessment tool in order to address these risks that we heard and help agribusinesses learn and adapt their practices in order, because they are willing, certainly. They don't want to harm the clients, but we need also to provide them with good practices of how to do that in the details.
And related to this tool, so you've just heard how well adapted it is to the complexities of this sector. Evaluation tools have a number of different purposes, and in this case, the idea is really assessment of your current practice, your strengths and weaknesses, in order to raise awareness, in order to help improve if you get a baseline idea of where you are. So why is that the focus as opposed to, say, certification of this is a good actor, that is a good actor?
So we have to recognize that we are at a very early stage still of developing this tool and these statements. So obviously we cannot already put it out there as a certification thing, and I think Agri has already a large set of certifications. So let's start from the start. What this tool can do and cannot do, and that has to be very clear, it's not a scoring tool. It cannot be taken as something where you expect as an investor to have high score and high full compliance at the end of your assessment. It's really rather to be used as a management tool so that the investor is able to identify the priorities on which you are going to work with your partners if you enter into a deal. What we've done is acknowledging that you can't work on everything at once, and that the agribusiness is still in development and maturing on these specific topics, and they don't have the systems and resources with a very large organization behind them to implement all of this. All the tool is designed to identify the priorities. So we have defined must-haves alpha that are for most urgent risks that need to be addressed. The rest of the must-haves, which really are risks that need to be addressed at some point. And then the indicators that we call good practice indicators that remain minimum safeguards in terms of client protection, because again, client protection is the baseline, is do no harm approach, so everything should be at some point taken into account. But to help these agribusinesses prioritize and slowly move on this roadmap to improvement.
Okay, so we'll move now to field examples. So Lucia, again, and it's early days, so we also want to do a call for participation. We are looking for organizations who want to test this tool and give feedback, but you have started that process, and so what are some of the findings so far from the early use of the tool?
Right. One of the emerging lessons, and there will be many more to learn, is challenges that come with service coalitions, and where is accountability when you have an agribusiness partnering with a financial institution, with an insurer, with an input provider, with a weather information provider. Whose responsibility is it when things go wrong? It is not easy, and certainly coalitions add a level of complexity that otherwise you would not have. But the spirit of this great tool at Cerise+SPTF, with the help of IDH, is that it is based on the principle that when you delegate, you also need to control. And some emerging practices that we see to do that on the field include when an agribusiness starts a partnership, the importance of including consumer protection assessment in the due diligence, and then moving on, including in your service level agreement also clear KPIs on consumer protection. Also important for the agribusiness and its partners to protect contractually and to include that consumer protection breaches are ground that could be sufficient for termination and for transition to other service providers, so that in case of big issues, you have an exit. Technology can help, and if you imagine partnering with an agent network, having agents using an app that has visuals, videos, scripts, intermediate steps to check the smallholder farmers' understanding helps harmonization of the quality of the interaction with the smallholders. But that is not sufficient, and you also are, it is also great practice to do audits, ex post, and mystery shopping. Something that is not very common, but it is very effective, is also to have steering committees at senior levels. And so senior management from the different organizations forming a coalition meeting regularly to discuss the feedback from the smallholders and the cases of consumer protection issues, which represent a reputational risk for both, are effective ways of managing.
And Thomas, would you like to comment in terms of risks you've observed in the field and maybe possible mitigating solutions?
Yeah, I think, I mean, I've given you a lot of issues, and I think what, and I'm not going to talk specifically about more risks, but
you're welcome to.
there's lots, and the more that we go into the fields, the more we learn, the more farmers we talk to, the more new sort of issues we uncover. But I think it's really important that we create a shared understanding of what these risks are, so that we can address them. And I think there's going to be a whole range of issues if you're looking at an agribusiness or a service coalition of different actors. And it's good to have a reference frame of where the issues could lie, so that you can go through it systematically and identify the most urgent ones. And that's currently something that we really lack in this space, because it's not really something that certification covers. And so this is really something that we want to start, is have a conversation with the sector, have a conversation with other investors, agribusinesses, financial service providers as well, how we can start moving towards a mature agricultural sector that hasn't really developed over the past 50 years, if we're really being honest.
Okay, and again, we are coming to near the end of our entire session, and I want, oops, I don't have my, hopefully you heard that, but so we're coming near the end of the full session, and once again we are going to have time for Q&A. So although there's a lot more to say about this, we're going to just now ask each panelist again sort of key messages that we want you to retain, and then we'll take some of your questions. So Anne-Laure, why don't we start with you just to shake things up and start in the middle? What are your key lessons you want people to remember from what they've heard?
Yes, thank you. I will start by saying the first sentence. Smallholder farmers are the most vulnerable clients, and we relate now also to the clients that PAYGo serves, which is interesting. And they face disproportionate levels of financial stress. This is also why the industry needs to start having their awareness raised. And I leave the rest.
And let's go to Thomas, because Lucia, you're going to end on our positive notes. So we're not entrusting that to you, but key messages.
Yes, no, I think it's critical if you are interacting with smallholder farmers that you understand the services that they have access to, how they are offered, and who's providing them, and really speak to farmers to understand also the issues that they are facing and how these could be resolved.
Great, and then Lucia?
So you know by now, thanks to this tool which goes into great details and thanks to the inspiring experience from IDH, that it is not easy to identify and manage smallholder farmer consumer protection risks. And still, as Thomas mentioned and Anne-Laure about the vulnerability, there is huge impact to gain if we only manage to do this right. And so yes, there are consumer protection risks, and so what do? Do you stay there and wait and not take risks? Or do you get your hands dirty, recognize that you will have challenges, for example, investing in agribusinesses, but identifying risks with a spirit of improving them over time, which is the intention of the tool, because in this case, consumer protection risks are worth taking, given the impact we can achieve.
Okay, thank you. And with that, I will turn it over to you guys. Do you have any questions for our panelists? I know it's getting late on a Friday. All right, well, if you do not, then we will just wrap up and then send you to coffee break a little early. But I wanted to end with some key messages from the entire discussion of consumer protection. And to start with the call to action, the risk is real and harm is occurring. So it must break your heart, as it does mine, to hear farmers, after all the work to get a crop, get cheated at the scales, and very poor customers, because they don't understand terms and conditions, end up getting more over-indebted, and when they already really didn't have any capacity to sustain that kind of damage. The studies that Eric shared of almost everyone's exposed to this risk has actually directly experienced challenges, and many are losing money. So the need is urgent. It's quite important. So that's something that I hope that you retain. But secondly, that there is this connection between doing this right and your own financial performance, your own long-term sustainability. We simply cannot ignore this and expect any of our institutions to survive. So doing good for the customers, being transparent, increasing their satisfaction, helping them avoid fraud is ultimately, as Jack so nicely explained, reinforcing the viability of your own institution. So we just can't forget, even if you're worried about the bottom line and you think, well, we'll have a call center later when I can afford it. It's not that way. You need it now in order to reinforce your long-term sustainability. And finally, the positive note is that we do have these tools and resources. So by now we hope that you know not only about the universal standards, but also specifically about the CP pathway. We have new indicators we're testing for DFS. We have the Agribusiness tool that you can now help us test and use. There's the assessment tool from the PAYGo space. We have the resource center that Cecile alluded to. So when you are ready to engage, the tools are there, and we certainly hope that you use them. So please do. And with that, my huge thanks to all of you for hanging in. I really thought that we'd be in a much emptier room. So thanks for your interest and your passion in this topic, and thanks also to my panelists. Let's thank them.